Imagine putting $100,000 into a stock and watching it grow into $3.4 million in just 13 years. Now, imagine selling too early, walking away, and missing out on over $3.3 million. That's exactly what happened to me with Facebook, now Meta. As of today, August 15, 2025, I only have 100 shares left. What could have been a $3.3 million gain turned into just $450,000. This is my story of how I missed out on millions and the powerful lessons every investor can learn. In 2004, I skipped Google's IPO at just $85 a share, and I kept watching, painfully, as it climbed past $600 by 2012 without ever owning a single share. I knew it was going to be a great company, with more and more people using it every day, but I missed it. So when Mark Zuckerberg launched Facebook's IPO at $38, I swore not to repeat that mistake. Facebook wasn't just another Google, it was rewriting social media, transforming the way people connect, and becoming part of daily life everywhere. By 2012, with 12 years of trading experience and over $100,000 in cash sitting in my E-Trade account, I jumped in. I bought Facebook stock early. And now I want to ask you, what IPO do you regret missing? Was it Google? Tesla? Something else? Drop your answer in the comments. Facebook's IPO launched on May 18, 2012, priced at $38 per share. But right away, many investors and analysts thought the price was far too high. Just 11 days later, on May 29, the stock slipped to $30. That's when I stepped in and bought 950 shares. By August, things got even worse. The stock crashed to just $20. Instead of panicking, I remembered Warren Buffett's words, "Be greedy when others are fearful." So I doubled down, adding 2,400 more shares. In November, the stock jumped out of a double bottom and reached $25. I took the chance to buy again, this time, 1,100 more shares. In total, I built a position of 4,450 shares. At an average cost of just $23 each. That's a $104,000 investment. At that moment, I felt like I had caught a giant. But little did I know, the real test was just beginning. Now let me tell you about my first big sale and also my first big mistake on Facebook stock. In October 2013, Facebook stock hit $55. My investment had already gained about 140%. I held on. Then came a sharp 15% drop and M-top on the chart. I told myself, I should have sold at the peak and bought back after the dip. But I took no action. Fast forward to 2014. Facebook soared to $71, over 200% gain from my entry. Again, the charts looked like another M-top. This time, I was determined to be smart. Catch the wave. Sell high. Buy back lower. So I sold 2,000 shares, nearly half my position, cashing out $142,000. I had already secured more than my original $100,000 investment, and the remaining 2,450 shares were essentially at zero cost. For a month, I felt brilliant. The stock dropped 20% soon after my first sale, just like I predicted. But then, it rocketed higher. It never came back down. I waited. I hoped. But the chance never came. I never bought those 2,000 shares back. They were gone forever. Have you ever sold too early and watched a stock soar without you? Share your story in the comments. Looking back, I realized my biggest mistake wasn't selling. It was selling too early, thinking I could outsmart the market. As Jesse Livermore once said, "It never was my thinking that made the big money for me. It was always my sitting. I should have just sat tight." Peter Lynch also warned us. Far more money has been lost by investors preparing for corrections, or trying to anticipate corrections, than has been lost in the corrections themselves. That's exactly what I did, trying to time the correction and missing the bigger move. Sometimes the hardest move in investing is to do nothing. February 3, 2016. Facebook stock had just recovered from a sharp 15% drop in January. Then it surged nearly 20%, hitting a historic high of $115. But then, 2 days of decline appeared. And for me, that was the signature. The pattern I always fell for. Sell right after the peak. Without hesitation, I sold 650 shares that day. The stock quickly dropped nearly 10% after my sale. In terms of short-term trading, it looked like the perfect execution. But after-sale analysis told me another story. That dip wasn't the end. It was just main force washing the market, shaking out impatient traders like me. Because after that brief drop, Facebook rose. Steadily. Dramatically. For the next 2 years. That's when it hit me. Not just the 650 share sale, but all 2,650 shares I had sold up to that point. Although they could be justified in the short term, they were actually big mistakes, treating a long-term growth company the wrong way. It was like treating kids as adults before their time. I had used a short-term mindset to trade a long-term growth stock like Facebook. So I made a vow to keep my remaining 1,800 shares as long as possible. But holding long came with its own challenge. From 2018 to 2020, the market was a storm. In late 2018, the S&P 500 plunged nearly 20%, the worst December since the Great Depression. Rate hikes, trade war fears, a global slowdown, even a government shutdown, panic was everywhere. My Facebook shares crashed 44%. My whole portfolio sank with it. Then came early 2020. COVID. Lockdowns. Recession fears. Oil crash. Liquidity panic. The market collapsed into one of the fastest bear markets in history. In just 2 months, my Facebook stock dropped more than 35%. But this time, I didn't panic. These weren't company problems. They were global shocks. And I believed both Facebook and the US market would rebound. In May 2020, I bought 200 more shares of Facebook at around $210. My only regret? I didn't have more cash at the bottom. Because in a crisis, no cash means no opportunity. In July 2020, my family moved back into our first house, an old home with a big lot in a nice community. I bought it in 2004, and after 16 years, its value had doubled. Not bad, but the house needed major remodeling. With interest rates near zero, I refinanced and cashed out to start the project. Costs soon ran over budget by nearly $100,000, and I had to sell some Facebook stock, 300 shares at $229 in May 2020, and 200 more at $331 in May 2021, both near record highs. After the sharp drops in 2018 and 2020, I was more willing to lock in profits. The sales brought me over $100,000 after taxes. In hindsight, the timing was fortunate, just before Meta's big tumble the following year. But more importantly, they funded a beautiful home renovation for my family, a trait I'll never regret. In 2022, Meta faced its greatest storm. Between September 2021 and October 2022, the stock collapsed 75%, from $380 to just $88. Apple's iOS privacy changes cut $10 billion a year from ad revenue. TikTok was stealing the young crowd. Instagram Reels failed to monetize. And Meta burned tens of billions chasing the metaverse dream, losing $10 billion a year with no payoff. At the same time, the Fed hiked rates, big tech crashed, and regulators circled. Confidence vanished. One earnings miss after another triggered record-breaking single-day plunges. In June 2022, Facebook officially became Meta. But the bleeding didn't stop. And me? I didn't sell. My cost was just $23 a share. Even at $88, I was still ahead. But watching $380 collapse to $88, 75% gone, rattled me more than I'd like to admit. After the brutal collapse of 2022, Meta staged one of the greatest rebounds in 2023. Mark Zuckerberg declared it the year of efficiency, cutting over 20,000 jobs and reining in metaverse spending. Ad revenues surged back. AI tools like Llama and smarter targeting reignited growth. Investors cheered as the stock more than tripled, one of the year's top performers. But me? I didn't fully grasp the shift. The 2022 crash still haunted me. When Meta climbed past $200 from its $88 bottom, I thought the recovery was good enough. So here's what I sold in 2023. April 13th, 300 shares at $218. April 26th, 400 shares at $212. June 26th, 300 shares at $278. July 3rd, 400 shares at $287. In total, 1,400 shares gone. Only 100 left. I kept those 100 as a memory of holding Meta for a decade, and the fortune it had given me. Also, as a reminder, be ready to buy back if Meta ever fell again. But here's the painful truth, it never dipped below $287. Those last sales locked me out of even bigger gains. After my final sale in July 2023 at $287, I was left with just 100 shares of Meta. Since then, the stock has exploded, climbing past $780 today. The rebound started with blockbuster earnings in early 2024. 25% revenue growth. Net income nearly tripled. And Meta introduced its first dividend, sending the stock up 20% overnight. Throughout 2024, Meta kept surprising Wall Street, revenue up more than 20%, earnings per share up 66%, and engagement across 4 billion users still growing. Efficiency gains and buybacks added fuel to the rally. By 2025, momentum only grew stronger. Meta poured tens of billions into AI, launched Superintelligence Labs, struck a $14 billion partnership with Scale AI, and began monetizing WhatsApp through ads and subscriptions. AI-driven ad tools supercharged targeting, keeping Meta ahead in digital advertising. Analysts lifted targets to $750 to $800, while even big names like Michael Burry bet bullish. The stock hit fresh highs. My remaining 100 shares have doubled since 2024. But here's the sting, if I had held on to my original 4,450 shares, they'd be worth about $3.5 million today. A painful what if. In summary, investing $100,000 in Facebook, now Meta, at its IPO 13 years ago, after all my buy, sell, and keep decisions, has grown into about $600,000, a 5x gain. But if I had simply held on to all the originally purchased shares, that same investment would now be worth about $3.5 million, or 32x gains. To put this in perspective, here are rough estimates of what that same $100,000 might have become in other investments over the same 13 years. 401k, stock heavy $345,000, or 2.5x gain. QQQ, NASDAQ 100 ETF $850,000, or 7.5x gain. Bay Area real estate, using $100,000 as a 15% down payment on a $700,000 house, with rent covering costs, would now mean $1.4 million equity, or over 12x gain. So, my real outcome with Meta, 5x gain, was only better than a conservative 401k and far below QQQ or real estate. On the other hand, the dream scenario holding all 4,450 shares would have beaten them all, delivering a staggering 32x return. The lesson? I cannot blame Facebook, Meta. The stock delivered. It was my actions, my fear, hesitation, and trading decisions that cost me the fortune. Here are a few timeless stock investing and trading principles, distilled from my $3.3 million lesson. Understand the stock you own. Treat long-term growth companies as long-term holdings, not short-term trades. Long-term patience beats short-term trading. Trying to time the market often leads to selling too early and missing the biggest gains. Don't let fear drive decisions. Market dips, corrections, and even crashes are temporary for strong growth companies, panic selling locks in regret. Diversification helps, but discipline matters more. Over-diversifying or chasing safe alternatives can dilute life-changing returns from a true winner. Cash is opportunity. Crises create the best buying opportunities, but only if you keep liquidity ready. The hardest skill in investing is holding. As Peter Lynch said, the key to making money in stocks is not to get scared out of them. Missing that $3.3 million fortune feels like losing my first dream girl in college. I watched her walk away while I stood frozen in hesitation. I told myself there would always be another chance, another time to act. But when that moment finally comes, will I be ready to embrace it?
Thanks for watching. If you found this video helpful, don't forget to like and drop a comment below. We'd love to hear from you. Subscribe for more insights on investing smart, growing wealth, living wisely, and walking with purpose. See you in the next video.